everyone. It's Valentina Sanchez Cuenca from the Birchops Report with the LATAM team. Today we have James Robinson, CEO of Robinson Speakers. He's the best translator from the finance world into the retail investor world. And we also have Larry McDonald, CEO and founder of the Birchops Report. So guys, tell me, what's going on today?
Valentina, thank you again for that very kind introduction. It's always a pleasure to have you on the show. And it's also a big, big pleasure to have our superstar of the trading floor, Mr. Larry McDonald, back in the studio. New York Times best-selling author of Colossal Failure of Common Sense. And he has a very, very interesting theory about the markets. I know that technology has been on an absolute tear for 2023. It's actually caught a lot of very, very smart hedge fund managers totally off guard. But will this rally in the Magnificent Seven continue? And we're going to hand the mic over to Larry, and he's going to tell us all why it might not be the best place to be invested in 2024. Larry, over to you. Like, what are the big signs that this could be at a top?
Well, the first thing is, what's amazing is, like, we have been here for 26, maybe 27 months at the same price level. Think about that. Think about that for a second. We are at the same price level on the NASDAQ and the S&P for roughly 26 to 28 months. And if you look at stocks like Tesla or Amazon, we're talking about close to 3 years unchanged, like dead money. Meanwhile, there's $78 trillion in the hands of the baby boomers, right? So your baby boomers are now turning about 78 or 79 years of age, and they have $78 trillion. So what's happening is money is exploding into money market funds, because at the end of the day, if you're the baby boomers, which have 78 trillion of wealth, and they're literally 78 years old, they're not really buying the NASDAQ here, and they're not really buying the S&P. They're going to cash, and that's what they should do when they're 78 years old. And remember, that's the oldest boomer, but the average boomer is probably in their late 60s.
So, Larry, I understand that the baby boomers are not going to be invested in technology. Okay, but what do you say to millennials, the younger generations that have seen such a fantastic run in technology, really ever since the pandemic? What do you say to them? Like, you got to think about getting out of this space, because it is at the top, and it's actually been dead money for 2 years because it gets so much press coverage.
Well, thank you, James. I mean, first of all, one of the dangerous things that we see, just look at this chart. We've gone from 16.3 trillion in the NASDAQ 100 literally 2 to 3 weeks ago, up to 18.3. So that's $2 trillion of extra value. And if you look at this chart, this is an incredible chart. In 2014, the spread between valuation, the spread between oil and gas, and that sector, the MSCI Global Energy, the spread between that and the NASDAQ 100 was only $600 billion. Today, it's $15.7 trillion. I'm going to repeat that. I want you to really think about this. Right?
And the spread is the difference in how much is invested, right?
Yes. So the spread between the valuation of the MSCI Global Energy Complex, the spread has gone from $600 billion in 2014 to right now $15.7 trillion. Just think about that. So
that's unbelievable.
So as a young person in millennials, there's a tendency to get sucked into like the latest trade, the most popular trade, what's on CNBC, what's on Fox, what's on Bloomberg. But This chart will show you that this is an extremely crowded, dangerous trade. And our book when markets speak, that's coming up in the first quarter. It's going to be a blockbuster book. We get into, and this is what you and I can talk about, what's actually going to create this massive, colossal migration of capital. A historic moment is upon us where money's going to move from big tech, which is financial assets, back to hard assets and real assets, which is really, think about it, it's like metals, materials. These, some of the biggest commodity shortages in the world, which we can get into, are coming at us. We're coming into literally the next 18 months a historic commodity shortage crisis.
It's unbelievable, Larry. I mean, the chart makes sense. It obviously looks like a very crowded trade, but the bull case on this, and this is what I keep hearing from these younger generations, especially from some people in my kite surfing group in Miami Beach in their 20s, early 30s, right?
Kite surfing, right?
Hey, look, this is Wall Street to Main Street, and I'm trying to be the average Joe on the beach. And this is really what I'm hearing. It's like, James, all of this value stuff that you keep talking about is old man money. This is the future, you know? It's the technology space. That's the future. This has nothing to do with oil. We're going into electric vehicles. Who wants oil? What do you say to them on that?
Well, Jose, if you can bring up the last, I think it's the last chart, would be great, the last one. But what I would say is, so if you think about the last like 10 years, last like 20 years, we took 5 million jobs out of the United States and we shotgunned them around the world, Bangladesh, India, China, and which is a good thing in the sense we've raised the standard of living around the world dramatically. But the problem is, I want you to think about this amazing stat. So you see that the left-hand side of the screen where we're talking about capital expenditures in the energy space, 2014. From 2014 to 2024, which is next year, the global population, James, think about this. The global population is up 900 million people, 900 million human beings. So the global population since 2014 to 2024 is going to grow by 900 million human beings. There's 1 billion people in China that don't have an automobile.
That's absolutely unbelievable.
There's a billion people in India that don't have air conditioning. So we've taken the 5 million jobs out of the United States. We've shotgunned them around the world. So we're raising the standard of living around the world. We're basically massively expanding carbon consumption in emerging markets. So if you're like a 25 to 30-year-old male or female in, say, India, you're making maybe 1,000 times more than your great grandfather. You're buying mopeds. You're working in a call center for AT&T, whatever it is, or American Express, and you're generating lots of income for your family. And you know what? The first thing that people do when their incomes go up is they eat better food, they get better transportation, and they get better accommodations at home, which includes air conditioning.
Yeah, so, that's absolutely right. And if you've ever been to India in July and August, you will quickly understand that that's first on their list, right?
Exactly. And so here's the thought that wakes me up in the middle of the night. This chart, you see the global exploration. So if you look at the pace from 2010 on that chart, on the left-hand side of that chart in the blue, from 2010 to 2014, those are capital expenditures. Those are investments from oil and gas companies in the future, right? And investments have collapsed. So we're essentially in a $2 to $3 trillion investment hole, right? At the same time, the global population is up 900 million over the last 10 years. So this is a lot of reasons for it. Number one, ESG, regulatory in Washington, lots of regulations on exploration of oil and gas. And then there's just, you had a horrible bear market in commodities from 2016 to 2020. So companies are really in a capital discipline mode. When all that means is if you're like an oil and gas company, you're paying dividends to people. You're not really investing because you just watched your last like 4 or 5 bosses get shot. In other words, the CFOs in the oil and gas space that made all those investments got fired, and so the new CFOs of the new management teams are investing money more carefully, and they're actually returning capital to shareholders. They're not digging holes for oil and gas, and meanwhile the global population's exploding higher.
Would it
Does
be?
that,
Yeah,
does that do you understand that to Mainstreet, or is that?
yeah. I think that Mainstreet can definitely understand that there is an underinvestment in oil exploration and the production of these fossil fuels. But do you think that it would be a fair, I guess, a fair assessment to say it takes about 10 years to really drill and get new oil online, right? With all the infrastructure that you have to build around it, you have to hire people, build the pipelines, get the transportation network in there. Do you think that these companies have a kind of a psychological scar about the faith in the US government or Western governments? Like, are you even going to be on my side when I get all of this online, which could take me 8 to 10 years and a huge amount of money? Like, who knows if we're going to be full batteries? Is it going to be illegal to have carbon emissions at that point? Do you think that that's also part of the problem?
Absolutely. I mean, politicians have been attacking oil and gas companies for the last like 5 to 7, well, for decades, but especially the intensity of this has picked up dramatically. So if you're a CFO, which is the chief financial officer at BP or Exxon or Chevron, you're very cautious the way you deploy the company's capital. Because, like you said, if you're going to make a 10 to 15 year investment, you're going to think twice about that. And so that's what I mean is we've dramatically suppressed investment. Literally, it's like a beach ball. We're holding underwater a beach ball. Meanwhile, the global population is up 900 million over the last decade. And at the same time, because we've decimated the Rust Belt, we've destroyed many parts of the United States of America. And this is all part of our next book, When
Which is
Markets.
basically the American manufacturing base is the Rust
Oh, it's
Belt,
been
right?
decimated, right? Decimated.
Yeah.
And so we've exported those jobs around the world, 5 million of them, which is a good thing for the world, right? Bad thing for America, good thing for money makers, young people in Bangladesh, India, China. But the problem is you're actually dramatically multiplying the consumption of carbon in these countries. And there's, like I said, there's 1.4 billion people in India. There's 1.4 billion people in China. That's close to, that's a lot of people. That's close to like close to 3 billion people in those two countries. And there's only like, there's a fraction of that in the developed world. But
Yeah.
when you see this chart to the left, James, what do you see there? It's the U.S. relative value. So it's the U.S. value of the U.S. stock market. So think of the NASDAQ, the S&P, relative to the rest of the world. Isn't that just a mind-blowing chart?
Well, I mean, it's obviously the US is completely out of whack, but is there a good reason for the US being completely out of whack with the rest of the world? Is there a reason that the US stock market continues to be the most popular place to park capital? I mean, when you look at the money in the Middle East, and if you look at the money in China, are they not buying US stocks instead of their own country?
Yes. And so what happens in investing is when a bull case is very, 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 very well known, money goes there. But when you get to a 2.8 standard deviation above a mean since 1950. So if you look on the left side of the chart, so we're going from
Yeah.
1950 to 2023. It's extremely the bull case for Apple, Nvidia, Google, Facebook. The bull case for these companies is so well known that too many people are hiding out in these stocks, and that's why. I mean, when you get up near 2.8 standard deviation relative to the historical mean, it's the most dangerous trade. I mean, literally, it's unsustainable. Like, who's going to buy? Like, it's a greater fool theory. Like, you need somebody else to come in and buy these stocks. That's why most of the Mag 7, I mean, most of these stocks, these great stocks, they're all unchanged except for maybe Microsoft. They're all unchanged for literally either 2 years to close to 3 years in the case of Tesla and Amazon. And
Right.
it's just too much money is hiding out in these what are perceived safe places.
Right. And do you think that the global value pool of stocks that we were just talking about, the energy sectors, et cetera, do you think that this oil demand on planet Earth has tipped us into an inflationary environment that we really can't dig ourselves out of without a significant investment in drilling and fossil fuel exploration in order to satisfy global demand? Do you think, I mean, because I know that oil does lead to recession, but you said on our last podcast that the days of $24 oil are over because the Saudis now really have the keys to the global oil well, and they're definitely driving the bus in that department. They are in charge of it.
Yeah, so what happens is when you have like from 1968 to 1981, we had an elevated level of inflation. We had an elevated level of bond yields, and we had a multipolar world where, there was more controversy in the world in terms of the countries. We had more. A multipolar world is a world where there's more animosity. There's two types of world, right? Unipolar is when there's globalization, everybody's working together. Multipolar is when there's the Vietnam War, the Korean War, and there's more controversy. Today we have obviously the war, the tragedy in Israel, and God bless the people of Israel and what they're going through, and then the people of Palestine, and then we have
Ukraine,
and we have the tragedy in Ukraine. 400, I think it's 400,000 human beings. It's just absolute tragedies. This is like so. What happens is from 1968 to 81, it was higher bond yields, higher inflation, and what prevailed in that kind of world was value stocks, hard assets, platinum, palladium, things like uranium, things like which is the URNM ETF today, or Cameco in the uranium space, or Alcoa.
it's
These
commodities, right? It's
so
commodity space.
Companies that own assets, like think of Barrick Gold. They own Barrick Gold is actually producing more copper than they've ever produced, right? So it's a copper and gold company now. So what's crazy about the gold mining space is you listen to companies like Barrick Gold, and historically you think it's a gold company. It's really becoming more and more like Freeport-McMoRan. It's actually a copper and gold company. So what I see here in this chart is since 2020, you see those higher lows, and that's like a staircase. This is an explosion ready to happen because we've got literally close to a $2 trillion deficit this year. One of the things that we talk about in our book is after Lehman, the fiscal and monetary response from Washington was about $3 trillion. But today, the fiscal and monetary response since COVID to now is almost 15 trillion, like 14.5. And so that's creating all that sloppy money is creating a demand for hard assets. So you can see this staircase. It sets up for a really bullish hard asset decade, and that's what our book's all about. When Markets Speak, we'll be out in the first quarter.
So you're basically saying that there are two things that affect inflation. It's not just oil prices, it's geopolitical safety on planet Earth, right? And so when the Earth is in a more dangerous environment, is that because trade routes become a little more dangerous and then it becomes more expensive to export products all around the world, like buying stuff from China? Is that where the nearshoring and the reshoring comes into play, which is a more expensive landscape to have your manufacturing because you're paying slightly higher wages?
Yeah, think about it. In a unipolar world with globalization, the trade routes are easy. There aren't as many global conflicts, and so you can actually produce products in Asia and bring them back to the United States very swiftly, and it's very deflationary. But in a multipolar world with, oh, by the way, higher intensity of labor unions in the United States, like the labor unions today in the US are stronger than ever. And for a
Right.
whole bunch of reasons, which we get into in the book, we don't have time now, but the unions today are stronger than ever. They're demanding higher. You saw the GM strike, you saw the UPS strike. Starbucks has problems as well. I mean, Amazon, these companies are paying up. So the companies being forced to pay up. Labor deserves a bigger seat at the table because they've been suppressed for a long time. And that leads to higher incomes, which leads to inflation. And then if you look at this chart here, I think this chart is one of the most important of the week, because one of the things we run behind me, a Bloomberg chat with 650 institutional investors in 23 plus countries. And one thing people are talking about this week, which is a really sexy story, is that oil and gas, which has been an incredible bull market, because recession risk is rising, oil and gas stocks like the XLE, the XOP, the OIH, they're under some stress of late. Oil's down a lot last two months. And for the first time, you see this, you can't see it really there that well, but the gold miners GDX is making a pretty interesting move. We think this type of move speaks to a colossal shift into precious metals. So think about the commodity space, right? There's different stages too.
So this chart, Larry, just to interrupt briefly,
Yeah.
this chart's an illustration of how money is moving away from energy and going into gold miners. Or does this illustrate, I mean, the chart's going down. What does that mean exactly? Does it mean that energy has sold off and gold? I never quite can get my head around these charts
Okay,
at a
I'm
first
glad you
glance.
asked. So as the line's moving down, that's money moving into energy companies and away from gold and silver miners. Okay, so
Okay.
as the line's moving down, and this chart goes back like maybe a year and a half, 2 years. So for the last like 18 months, money's been moving out of precious metals, so silver and gold miners, and into the XLE, which is your Exxons, your Chevrons, your Schlumbergers, the XOP. So now money's
I
moving
see.
out of those names as the line goes up. That's where
Right.
money's moving into your Barrick Golds, your Newmonts, your Agnico Eagles, and it's moving out of your Chevrons, your Schlumbergers, and your BPs.
I see, I see. So if it was broken up into two charts, the energy would be going up and looking very toppy right now, just kind of rolling over, and the gold miners would look like a real bear, like a real oversold sector. Is that right?
Yes, yeah, that's right. But to look at the chart,
Okay.
this to keep it simple, is that you can see that far right hand corner. That breakout speaks to a potential big shift out of Exxon, Chevron, and into more capital, or just more capital in the commodity, like more capital in the commodity space, moving into precious metals and having less interest in oil and gas.
And this is also going back to the first chart of the massively overbought technology sector versus this sector, because you come from a school of thought that says always get on the least crowded side of the boat. You never want to follow the herd as a trader and as an investor. You want to get into the unpopular sectors. Is that what you would tell Mainstreet today?
When I was coming up, and you're a lot younger than me, I'm an old man now, Peter Lynch was the Hall of Famer, right? In the line I remember when I was 18 years old I read his book, One Up on Wall Street in the 80s. And he's like, the stock and sector I fear the most is the hottest stock in the hottest sector. And the most popular crowded trades are the most dangerous ones, even though they look like you think about common sense. Like you think, oh, being in like Apple and Tesla and Microsoft, you think that's really safe, right? But Apple's trading in like 7.3 times sales. And for the last 20, 30 years, it traded at 1 to 3 times sales. And you can go through, same thing with NVIDIA. NVIDIA right now is trading at 35 times sales, and Intel here is trading at a fraction of that. But here's the thing that blows me away. Like, you'll never hear this on the major financial networks, but Intel is outperforming NVIDIA. And this speaks to growth versus value. So Intel's a value stock. It's like a really, like Seth Klarman was buying Intel. The Hall of Famers like David Einhorn at Greenlight Capital in recent years are buying Intel. Intel is a classic value stock, whereas the SMH and which is the semiconductor ETF, and NVIDIA are filled with growth companies like NVIDIA. And what's mind blowing is if I told you that Intel is outperforming NVIDIA by like close to 30% since May, would you believe me?
It's unbelievable, Larry. I wouldn't believe you, but I looked at Intel yesterday, in fact, and it's gone from $24 to $43 in the last 8 months. You'd be a brave man. You'd be a brave man to be buying it at $24, though.
But that's the thing. It's like seller exhaustion. Bear market with Intel in the last like 3-4 years. Everybody gave up on it. The street had in January. The street had the most sells on Intel of all time. I think it was like if you think of all the analysts on Wall Street, it was unanimous. The most unanimous sell recommendations in the last, literally, in the history of Intel. And then it goes on this run. That's the genius of contrarian investing is you want to be there for the turn. You want to be there for that moment where seller exhaustion peaks out.
And there's a quote by Warren Buffett, who I know everybody loves. And it's such a wonderful quote because it really works for your trading theories or your buying stock theories. Because you're always going to go through some pain when you're buying a massively sold off sector. And he said this: stocks are a terrible investment for the short term. They are a wonderful investment for the long term. And so, quite often when you buy a stock, let's say it's $28, it's come from 60 and then it goes to 22, you dump it. You don't buy more. And then you look again in a year and it's at $52. It's just that happens over and over again to people. They get in, they think it's great, and then they lose their nerve. What do you say to people like that? How do you get some Wall Street trader bravery when you get a new position?
Well, the ultimate key, like when I was in my 20s and 30s trading, and you tend to chase things. You tend to try to buy breakouts, and that's the thing with Twitter today and technical analysis. Everybody's doing the same thing. Everybody's buying breakouts. And if you look at Tom Lee, guys like Tom Lee, and he was an analyst at J.P. Morgan. Now he has his own company. But all they do is just try to buy momentum, right? The problem with that, we've been dead money in the S&P for 26 to 28 months. And so if you've been doing that the last 2 years, you've lost a lot of money. You blew up your clients in 2021 by buying. If you were buying breakouts in November of 2021, you blew up your business, right? So you want to be very careful buying breakouts in a market that's gone nowhere for 2 years, because at the end of the day, we're coming into a massive commodity crisis around shortages, which we can prove to you in our book. We have all the stats, the global population, underinvestment. And so you're coming into a new decade. Forget about the last decade's portfolio. That's where the dumb money is. Everybody's looking backward. Let's look forward. Let's look at the shortage of oil and gas that's coming upon us. Let's look at the shortages of copper. Let's look at the green revolution. Okay, you want to go carbon neutral, then we're going to need a lot more oil and gas. We're going to need a lot more copper. We're going to need a lot more aluminum. The U.S. power grid is, in some places, 50 years old. Do you know how much copper it's going to take to rebuild the U.S. power grid?
And I hear it's 600,000 miles of copper is going to be needed. That's a lot of copper.
These are the trades of the future. I think, and I'll make a prediction right now, within the next 5 to 10 years, you're going to see a BHP bullet in the top 10 stocks or 15 stocks in the S&P 500. You're going to see, uh, a Chevron up there, like in the old days, which you saw in the 70s. But everybody, for some reason, because everybody thinks because inflation's come down in a fast pace, the Fed has hiked rates aggressively, inflation's come down. And so everybody's like, okay, ho, ho, ha, 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 ha. We're going back to the old playbook. And it's the dumbest money in the world. The next year in 2024, you're going to see that 18.3 trillion that's in the NASDAQ 100 right now. I'll make a prediction. A year from today, it's going to be less than 12 trillion in the NASDAQ 100 because we're in that multipolar, higher yield, higher inflation world.
I mean, we still have two wars going on that look absolutely brutal. Not to mention, your good friend Neil Ferguson has said, without a doubt, we are in a Cold War with China and Russia. And this is looking geopolitically a lot more like the early 1980s than 2013. Would you agree with that?
Yeah, the geopolitics is, and that's where you get into the multipolar world because that changes the trade, the trade system of the world and the trading routes. And that's where, I sat down in Brazil, I did a speech and I met with Andre Estefes and he was like, listen, we're going to have a north-south supply chain between the United States, Mexico. And that's why look at the EWW, look at the Mexican peso. This companies are massively investing in Mexico because they're the connection point between the United States, Chile, and Peru and Brazil. They're the connection tissue, and that's why you're seeing this potential north-south supply chain in this hemisphere, right, develop because everybody was burnt because of the unipolar world. In a unipolar world, that east-west supply chain has burnt hundreds, if not thousands, of companies. And if you look at there's a chart which we don't have now, but it's been going around. A couple clients put in the chat today. It's a comment on reshoring and nearshoring, and if you look at the conference calls across the U.S. companies in this earnings season, it's an absolute explosion in nearshoring and reshoring commentary, and that tells you that we're going to potentially move into a north-south supply chain instead of an east-west, and that's just more inflationary because for a whole bunch of different reasons. Because if you're going to move,
more expensive.
The labor's more expensive than in Asia, but it's also like, okay, you're going to move.
You have to move your materials as well.
Your material, you need like two production facilities. If you have your production facility in India and China, and then you have to have another one in Latin America. It's just a higher cost of doing business. They have to pass that on to consumers.
Right, I see. So listen, Larry, we're coming into the final couple of minutes of today's show. I think it's been an absolute fascination. I hope that Wallstreet tactics have been very helpful to any Main Street investors out there. But just a final thought on this technology front. You do not believe it's the 2024 trade. You think it's going to massively underperform. So what would you tell people now that have portfolios that are massively long the Mag 7 and the NASDAQ in general? What would you say, how should they be positioning themselves coming up to the Christmas season and starting the new year?
Well, with the highest conviction, the one thing there's a number of things you learn over 40 years on Wall Street is when you have a year where there's big performance of the S&P and say the NASDAQ, and so there's a massive divergence between winners and losers. What happens is if you're long Microsoft right now and you're up, whatever it is, $100,000, $10,000, $1,000, whatever it is, you know what? If you sell it now, you have to pay the taxes on April 15th, right? But if you sell it on January 3rd, you have to pay the taxes in April of 2025. And so what happens is if you get through that October period of bad seasonality and then you go into the year end, a lot of people are going to sell those winners in January. So I see the next, between now and February, I think we could have a 20-30% down move in some of these big names because everybody's crowding out into them There's a lot of cheap stocks. So the cheapness of, say, the Russell 2000 versus the NASDAQ, or the Russell 2000 versus the S&P, is one of the cheapest levels in the history of the markets. And so the cheapness of value stocks, the cheapness of hard assets. And so people have huge gains in these NASDAQ 100 stocks. Like I said, $18.3 trillion is in the NASDAQ 100. And so you're going to see a massive migration between now and when our book comes out in the first quarter. And it's just going to be potentially $3 to $5 trillion exiting. And it's going to go. We're not talking about really a market crash, but don't forget one thing. One thing to take away from this conversation: there's several sections of the market that have already crashed. We did a trade alert a couple of weeks ago on the regional banks. We're doing trade alerts on some of these hard asset companies. These and some of the retailers, we've done some trade alerts in the last 2-3 weeks in some of the retailers. These stocks are trading extremely cheap to crowded financial assets like the NASDAQ 100. This is a great migration. It's coming. You got to be ready for it.
So SQQQ would be a great stock, and then get long XLE, XME, GDX. That trade, how does that work out? How do you feel about a trade something along those lines?
Yeah, so I would say you want to be selling your NASDAQ 100 names, and if you want to get aggressive, you would buy something like the SQQQ.
That's the short NASDAQ ETF.
Short NASDAQ, yeah, that's short the NASDAQ. Emerging markets like the EEM, the KWEB, like the KWEB technology stocks are the cheapest all time to U.S. technology. And so emerging markets do really well when the Fed stops hiking. And so we want to start thinking about value, want to start thinking about hard asset companies, like you said, the GDXJ. Really love that here. That's the gold miners on the junior side. We really love the SILJ, which is the silver miners on the junior side. And we really love a lot of these value stocks, like the Intels of the world. Like there's so many, the EWU, which is a basket of global value. Global value stocks are the cheapest to the NASDAQ and the S&P in our lifetimes. This is an incredible opportunity. Go get it. And once you kick it back to Valentina.
Larry, those insights are fabulous. Thank you so much for making the time. I hope everyone enjoyed listening to Larry McDonald. He's one of my favorite traders, and I love him because he's a distressed guy and he is a contrarian. And quite often you need guys like that in your corner. So, Valentina, back to you. And we just wanted to say one thing, actually, before we kick it back to Valentina. If anyone has any questions about their portfolio, please leave a comment in the comments section under this video. Give us a like, give us a subscribe. It really helps spread the word because we're here to bring Wall Street to Main Street. Thanks again for listening. Okay, now over to you.
My friend. Well said. Thank you. That's perfect. Thanks.
Over to you, Valentina.
As Larry mentioned throughout the video, we run an institutional live chat on Bloomberg, and you can get a trial to that for 21 days. Or also, if you're on the retail side, you can reach me out at valentina@thebirdshopsreport.com. That's valentina@thebirdshopsreport.com. And I can offer you a free trial. Also, don't forget to pre-order our upcoming book, How to Listen When Markets Speak. Everything in the description down below. Don't forget to subscribe and also turn on the notification bell so you'll be the first to know when we post a new video. Thank you so much.